Hello everyone, welcome to week 10 lecture videos. We have 5 learning objectives today and we start with learning objective 1. In this learning objective, we discuss different kinds of managed fund investment vehicles that operate across Australia. The basic idea of all managed funds are the same. They pool capital from a lot of investors and invest somewhere for the benefits of the supplier of funds. This is generally achieved by being provider of funds in the market, for example, by buying a whole lot of financial assets, which can be either in the primary market or in the secondary market. In the primary market, for example, could be a venture capitalist trust, which is a trust that's set up to buy a whole lot of shares through buying companies, and secondary market might be buying and selling a range of assets including shares, bonds, and alternative assets. The key benefit of managed fund is that they provide diversification and divisibility. This means that for a relatively small amount of money, you are able to diversify across a broad range of assets that might otherwise be not possible without the presence of managed funds. The divisibility is the process of securitization, which means that managed funds purchase large assets, for example, real estate, and create units against this asset. Because of the process of units being created through this securitization, the returns on that asset is basically divided up across a range of different investors who buy those units, and such investors are actually get the benefit of divisibility in effect of buying a small divisible component of the big assets. Funds can also be beneficial because the pooling of capital and pooled investment can result in reduction in transaction costs, and you can also take advantage of professional portfolio management and record keeping. The key types of funds that we see in existence in Australia are those listed in the screen: insurance funds, superannuation funds, various investment unit trusts, managed investment funds, real estate investment trust, exchange traded funds, and hedge funds. Across the course of this lecture, we discuss each of these different types of funds and talk about some of their benefits. Now, if we plot the assets under management of these different types of funds in Australia through time, we can see that while this does appear to be some growth across all the funds, however, the largest growth by far and away, the largest source of funds under management in Australia is the superannuation funds. Since superannuation became compulsory in Australia, we have seen this exponential growth taking place over time. This decline here is because of decrease in the value of assets being managed as a result of the global financial crisis. However, other than the GFC period, this continued upward trend indicates a dominant market player. Now we will discuss each of the different types of funds briefly. First of all, insurance funds. The insurance funds are the pooling of funds together that are contributed to the insurance company. The idea is that providers of funds are paying premiums to be insured against some pre-specified events. Now, the insurance company will take the money that they receive from the policy holders and they invest in different securities. The time period of their investment will depend on their liquidity needs. We tend to find out that general insurance companies that insure against unwanted events associated with motor vehicle, home property, air travel, or other related topics, they tend to have more unpredictable and short-term needs of capital, so they will invest in more liquid assets. On the other hand, life insurance funds tend to have more predictable payouts and longer-term investment, so they will invest in risky assets that have less liquidity and higher return to maturity. Now, when these assets are invested, the legal ownership of the assets remain with the insurance company themselves, and the insurance company will then have individual contracts with each of the ultimate beneficiaries, who are the insurance holders. With insurance company go about investment, they try to invest in a way to hedge against their liabilities. So they try to make sure that the duration and the risk of their investment is matched against the equivalent payouts that they may have to make in the future. A second type of fund that we see in Australia, and as we spoke about earlier, this is the most dominant type of fund in the Australian market. This is superannuation funds. Across the world, the superannuation funds are known as pension funds. So there are basically two types of superannuation funds. One is defined benefit plan, another is defined contribution plan. So in the case of defined benefit plan, this is just a pooling of funds together. With the defined benefit plan, where the amount that the superannuation funds unit holder is paid at their retirement is a function of some formula. That formula is usually modeled using their years of salary, their years of employment, and potentially other variables like their age. So in the case of defined benefit plan, the return you get does not depend on market forces. The second type of superannuation is a defined contribution plan. This is where investors put in a particular amount of money on a regular basis, and the amount available to them at retirement is the amount they contributed in the superannuation, plus or minus any capital gains or losses that are accrued on the account across the period of investment. Now, as we saw earlier, superannuation has grown significantly in Australia in terms of funds under the management over the last 30 years, and there is a good reason to this. Since the 1st of July 2002, the employers have had to contribute a minimum of 9% of their employees' earning to a superannuation, which is known as superannuation guarantee, and this is actually slated to increase up to a level of 12% by 2020. So the amount of superannuation assets under management is only expected to grow into the future, and superannuation funds are the most dominant form of institutional investors across Australian financial markets. Next group of companies are unit investment trusts. Unit investment trusts are pool of funds that invest in a portfolio of shares for the life of the fund. So a unit trust is generally formed by some sponsor, and often the sponsor will be a brokerage firm who will buy a portfolio of securities that are then deposited within the trust. Once the bundle of securities is held together within the trust, a range of units can be created with the trust, where each unit has a pro rata right to the cash flows of the trust, and the units are sold to investors. All the income from the portfolio is paid out to the unit holders in proportion to the number of units they own. But the key aspect is that an investment trust is not tend to be actively managed. So it tends to be that there is an initial portfolio that's trapped upfront, and the same portfolio will be passively held across time. This phenomena decreases management fees. But unit investment trusts had declined in popularity compared with other fund management structures across time. The reason they are declining popularity is because on one hand, you don't get the benefit of active management, whereas on the other hand, there is actually cheaper ways to access investments in the passive portfolios now other than investment trusts. These are known as exchange-traded funds. Hence, basically, there is not really much of a role for unit investment trusts anymore. Now, one thing we do know about unit investment trusts is that they may liquidate their investment by selling their units. Investors may liquidate their investment by selling the units back to the trust at net asset value. Net asset value is a key concept because net asset value and this redemption process is how funds differ from each other. Net asset value is calculated as the market value of assets in the fund less the liability divided by shares outstanding, and that's giving you the market value of each unit. The majority of funds calculate net asset value at the end of the day. So what this means is, now if you decide one day that you want to redeem your units or to sell your units back to the fund, then the value that you receive will be the net asset value as at day's end. So unlike shares that are traded on exchange, this process of calculating net asset value means that you can only redeem your units on a daily basis. Unit trust can be either listed or unlisted, both types exist, and the trustee may either sell part of the portfolio to fund the redemption of units when an investor does decide to redeem, or they may wish to sell those units to another investor, thereby keeping the same amount invested in the portfolio. Alternative to investment trust is a managed investment portfolio, managed investment company. Managed investment company is a fund where you have a manager providing oversight to the fund because you have got the professional management. They will generally charge an annual fees that ranges between 20 basis points to 150 basis points per annum. There are two key types of managed investment companies. There are open-ended funds and closed-end funds. Open-end funds, first of all, they issue and redeem shares of the fund at net asset value. So basically this means that the size of the fund itself can expand or contract across time as either investor seeks to purchase more units of the fund or as investor redeem their units and wish to sell back to the fund. There are some open-ended funds that are traded on the Australian Stock Exchange, and they are known as listed investment trusts. On the other hand, closed-end funds have the same amount invested within their portfolio across the life of the fund. Apart from the initial public offering, they do not issue shares and they do not redeem shares. Therefore, if you invest in a closed-end fund to liquidate your position, you need to go and sell shares to another investor. Managed investment companies in the form of closed-end fund also may be traded on exchange, and the market price should closely match the net asset value. However, it's often been observed that they are traded at a price below the net asset value, which is known as closed-end fund discount and considered as an indicator of investor sentiment. The next type of managed fund is real estate investment trust. These are trusts, again, like those we spoke about previously. The key difference here being the underlying assets or the portfolio of assets are real estate assets. So the portfolio is a bundle of real estate assets and they are put together, then they are securitized, meaning a whole lot of units are created and those are sold off to investors. In Australian market, real estate investment trusts are often abbreviated AREIT. Finally, and quite importantly, because of the growth in popularity over recent times, is exchange-traded funds. Exchange-traded funds are investment funds. The key difference is they are traded on exchange just like a stock. The exchange-traded fund itself will invest in a basket of securities, again create units over those securities and sell to investors. They exist for a wide range of asset classes, including equities, debts, currencies, and commodities. So they are an effective way for investors to get access to a range of different asset classes while also having a higher level of liquidity because they are traded like a stock on the market and relatively low transaction costs because you don't have the high management fees. Exchange-traded funds tend to be open-ended funds in the form that the number of units may increase or decrease in response to demand and supply. So for example, if an institutional investor decides that they would like more units in a particular ETF, often what will happen is the ETF sponsor will simply go out to expand their portfolio to create new units, and those units will be sold to that institutional investor. This is the end of our discussion on Learning Objective 1. Please watch the next video for a discussion on Learning Objective 2. Thank you very much.